How's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group. Today's topic I want to discuss with you: what is an annuity, and why do people leverage annuity for, for retirement or some sort of safe accumulated growth within their specific accounts? And whenever you see the word annuity, you have to think of the word leverage, or you have to think of the word cash flow. It's essentially nothing more than a leveraging a specific product for a lifetime cash flow or specific cash flow amount of dollars for your specified age. What do I mean by that? Well, typically what happens is you have an individual that works for a company. When they work for this company, typically the institution, they offer them some sort of retirement plan. So they might say, okay, you've been working for this company. We might be paying you, let's say in this example, $100,000 per year. We're going to give you the rights to place money, premium dollars that we're essentially paying you, designated a secondary portion into a retirement bucket. Now, this retirement bucket might be known as like a 401k, it might be known as a 403b, a TSP, etc. There's different things set up through the employer. So what happens is this person is placing dollars in, and also that employer might be matching contributions into this plan. So ultimately, if you're placing more dollars and the company is also placing dollars into your bucket, then essentially your bucket should grow at the end of the day, at the end of the year, right? And that's unfortunately where it all depends upon how well the performance does within this bucket. If you just had it regularly in a fixed account, like a safe fixed account with your 401k account, it might give you like a 1% rate of return, meaning yes, and that theory would be correct. The amount of dollars you place in there and the amount of money that the company is matching is going to be increasing, by whatever you're placing in there and the 1%. But what happens is you have with that 1%, it's such a small rate of return that this slowly gets eaten up by inflation. The cost of goods increasing year by year by year. Rule of thumb is that inflation increases by about 3% per year. So what's there a way to grow this bucket even faster? And that's where individuals choose the mutual funds within their specific accounts. They might say, okay, my 401k gives me 5 to 10 different mutual fund offers. Let me go and, try to reallocate this money, diversify all these different mutual funds to have growth at the end of the day. And unfortunately, what we have been seeing in more recent times is something known as volatility, where one day the market's going to go up, the next day the market's going to go down, and this individual that was accumulating all this money for a long time, has been having this, his heart has been in his throat. He's scared as all heck, or she is scared as all heck. And that's essentially where you could leverage an annuity for a specific goal, for a specific purpose, that takes away that big question mark in retirement and gives it a little bit of certainty. Now, with mutual funds, like anytime that you try to accumulate your monies in like a 401k account, a 403b account, etc., you have that mutual fund related risk. There's downward market loss, the potential there, but then on top of it, you also have mutual fund related fees and different administrative fees, regarding that type of retirement account. If you utilize a financial advisor, a traditional financial advisor, that they give you recommendations, they're typically going to charge you some sort of advisor fee known as a wrap fee. So all these combination of negatives is making your accounts have an uphill battle struggle every year just to break even within your account. What I mean by that is if you're getting charged a fee of like 1% and a mutual fund fee of another 1%, before the market does anything, before your account does anything, you're already 2% in the hole. So if you're placing money into that account, you already have to have a negative 2%. And then if the market goes up, then obviously you can cancel that out. If the market goes up 10%, well, then you're only really netting 8%. If the market goes down 10%, well, then you're really netting negative 12%. So what's their ways on how you could, leverage traditional accounts and roll them over when it starts coming time for retirement? And that's how an annuity could really come into play. Now, it's not only just retirement accounts; it's also cash accounts. If somebody sold a business, or if somebody, sold a house and they have a lump sum of cash, or they came into an inheritance, you could also leverage an annuity for that aspect. So enough with my rambling. What exactly does an annuity do? And it provides income streams at a couple different ways. So, if let's say you're age 55 and you understand that you have a bucket of money, let's say it's $500,000, and this $500,000 is going to be designated for retirement, but you don't want to retire until age 65. Well, what you could do is take that $500,000 or whatever portion of that, you place it into a specific annuity contract or multiple annuity contracts that will give you some sort of income guarantee at that later date. This is known as a deferred annuity or deferred income annuity, where essentially you're deferring your growth for 10 years and the company is giving you some sort of contractual agreement, some sort of contractual guarantee that they will pay you an income stream for the rest of your life, for 10 years, for 5 years, whatever that is for you and your spouse's life. But understand that you could mold it specifically to your situation. Now basically an annuity can only be offered through insurance companies because of the safety that's involved with these types of contracts. Okay? So you can't go to a bank and get an annuity, just like you can't go to an insurance company and get like a bank CD. You have different levels of safety, and these safeties are known as legal reserve structures. So with that being said, this situation where the guy is 55 and he's looking at age 65 to take out income, if this person has $500,000, the correct amount to place into annuity is the smallest amount possible, but making sure that you're getting the most optimal result. That's the best answer that you could really have from anybody telling you how much to place into an annuity. Because what you're doing is you're trying to get as much money, as much cash flow off of the smallest dollars by leveraging the company, leveraging the insurance company, and the insurance company is going to guarantee you specific income streams. Now, how exactly does the insurance company do this? And it all goes by a combination of fixed interest rates and mortality tables. If they understand that premium dollars are going in there, let's say somebody's going to have their contract for 10 years, they could essentially take that money, invest it on the back end, and make money off of your money. Now, they have to do it on a safer route than how banks do it, but understand that they could still offer that specific contractual guarantee based upon the claims paying ability of that insurance company. Mortality tables come into effect is because they have to know, okay, if we're going to pay a male or a female at age 65, we're going to pay them for the rest of their life. How many payments are we going to pay out? So that's where a mortality table comes into effect as well. So that's basically the nuts and bolts of how an insurance company is able to leverage all their resources for the individual that's purchasing their contract. You have different types of annuities out there. Okay, you have, and this is very sloppy, so I apologize for that. I know I get a lot of comments on my videos of how sloppy my handwriting is, but it's the way that I think, it's the way that I talk. So just give me a break, guys. It's immediate annuity is meant for an individual that's looking to place a specific dollar amount into an annuity contract and get paid for a specific amount of years immediately. So these were the first types of annuities that came out. Essentially what would happen is, let's say if a person's 60 years old and they say, okay, I have $100,000 and I want to use all this money for retirement, well, then they could go to an insurance company. The insurance company says, all right, it's going to cost you $100,000. Within 30 days, we're going to start paying you, $6,000 a year. So this person understands, let's keep it simple, $5,000 per year. So this individual understands, okay, well, $5,000 divided by 100,000, this company is going to guarantee me $5,000 every single year. If I outlive 20 years, well, then I'm beating out the insurance company. The insurance company's losing. But if, let's say, this individual passes away after 5 years, which would be $25,000 that got paid to him, well, now the insurance company's walking away with 75 grand of a profit. So this is why annuities had a bad reputation, was because the insurance company understood all these years and years of mortality tables and actuarial tables to use it to their advantage. So that's why immediate annuities are still around, but that's not the only type of annuity. Just like anything, there's been innovative changes with these types of products. Ones that are far beyond how an immediate annuity, where this individual would essentially have to lose control and nothing would get paid to his beneficiaries, they started stepping up and realizing that there's ways that people wanted other features regarding these annuities. So the general shell of an annuity is to provide income for life, but you also have different nuances that could help you in a specific situation. Hence why the fixed annuity was created. Back in the 80s and 90s, you had interest rates were in double-digit figures. So this is going off of a fixed annuity. If you had interest rates that, let's say a typical bank CD was paying you 10%, well, an insurance company offering a fixed annuity would probably pay you 12%. So it's a little bit higher than what the bank CD route was. So they both have very safe legal reserve structures set up to make sure that your money is safe, secure, and protected. And what would happen with this fixed annuity, which it would be kind of like an account, take that same guy who's age 60, say $100,000, he wants to purchase a 5-year fixed annuity or a 5-year bank CD. If he purchased a 5-year bank CD, this person understands that he's going to get paid $10,000 every year for the next 5 years. After the 5 years are done, he's going to have $100,000 left. So it worked out really well. It was so simple to utilize a fixed annuity for retirement income planning. Now, unfortunately, interest rates have dropped to all-time lows. So that was the bank CD example. If you utilize a fixed annuity example, instead of going with a 5-year bank CD that's paying you 10%, you go with a 5-year fixed annuity that's paying you 12%. So this person will get $12,000 per year for the next 5 years. After those 5 years are done, take the $100,000 and just basically roll it over into the next fixed annuity. Now, when those interest rates have become all-time lows, they're not paying 10%. They're not paying 12% anymore. Now, you'd be lucky if you could find a 5-year bank CD, or I mean a 5-year fixed annuity for 3% and a 5-year bank CD for 1.2%. It's just times have changed and interest rates are at all-time lows. Now, if they peak back up, then understand that your income planning needs are going to be very simple by just leveraging certain fixed accounts. But until that time happens, you have to look at different alternatives out there, because what happens there, if you go and you place your money in a bank CD that's paying you 1%, and you have $100,000, that's only $1,000 that you could live off of for income per year. A bank, or rather a fixed annuity that's paying you 3% and you had $100,000, would only be able to provide you $3,000 per year. So because interest rates are at all-time lows, it's hard to use that fixed annuity route for retirement income planning anymore. But you could still use it for a safe peace of mind, paying better than fixed interest rates, or checking account, savings account, money market accounts. Fixed annuities are good alternatives for more of that old school investor that just doesn't want to see any loss and just wants to see some sort of gain into their account year by year by year. Now, then came about with the other different types of annuities out there, kind of like the variable annuities. And these are ones that I don't like, is because essentially what happens is you're placing your dollars in there. It's in an account that's hit with miscellaneous insurance charges, and it's also tied to mutual funds. So kind of like how I didn't like that example before, when you go and you have your 401k account, and because it's tied to mutual fund options, it's tied to the different fees there, possibly advisor fees, and also tied to downward market losses. Variable annuities have all those features, but they're accentuated. So this is why, like a lot of financial specialists, you hear Susie Orman say that she absolutely hates variable annuities. I actually agree with her on that one. And a lot of people hate a lot of advisors. Just to be honest, a lot of advisors hate Susie Orman. That is one thing I do agree with Susie Orman on, is because I believe that somebody that's placed into a variable annuity is going to be paying so much in fees, so much in different hidden variable annuity fees, that their accounts are going to struggle to go up. And when the market actually does go down, it's going to have that downward market loss impact and those additional fees, much higher than any sort of 401k or other types of retirement accounts. Now, one of the good things that variable annuities did was they were the first ones to come out with something known as an income rider, a secondary account that kind of takes that blend of of an immediate annuity or some sort of deferred annuity of lifetime income, and do it specifically through an income rider. So it does not annuitize your contract. You're not surrendering your money to the insurance company by doing that. And that's kind of where the hybrid annuities came about, and why I really like the hybrid annuities. But if we just go down to the next annuity, the next type of annuity, which is very similar to a fixed annuity, is an index annuity. Individuals go and they place their money in an index annuity because they said, well, I don't really like that variable annuity because my account could still go down to downward market losses, have the different mutual fund related fees, have the different mortality and expense fees, miscellaneous insurance charges, etc. That all they're doing is just putting it into some sort of variable account and then claiming that it's through an insurance company, making sure that this is known as an annuity contract. Now, an index annuity is a little bit different. This kind of takes that same concept of the fixed annuity, where let's say that individual has $100,000 Well, what they say is, okay, we're not going to pay you a fixed interest rate year by year, but essentially we're going to take whatever a fixed interest rate was going to go into your account and we're going to invest that into the market. So when you invest that into the market, the only thing at risk is the interest that you would have gained that year. Rather than investing in just regular stocks and bonds, they invest this into institutional call options, meaning that if the market goes up, they're getting these call options at an extreme discount, meaning that this call options purchase a sort of position on like an S&P 500 or some sort of other stock market index dependent upon that company. So if you go have $100,000 in there, what you're going to notice is this is kind of equivalent to like a bucket with a little lid over it. Any time that in this example, if you had an S&P 500 call option that has a cap of 10% and a floor of 0%, this means that anytime that the market gains over 10%, you're going to receive a 10% credit into your account. Anytime the market receives a negative 10% loss or any sort of negative, you're going to receive 0% into your account. If you receive 5%, well, it's in between 0 and 10%, so then you're going to receive 5% into your account. So what this does is it gives you that peace of mind that you're not going to lose any of your account value, and also accentuate those gains, ratchet in whatever those gains are year by year by year, and try to beat that pace of inflation and beat out those low interest rate environment, that's currently only paying about 3%. So in a given scenario, if you go and you have a fixed index annuity, and let's say it's like a 5-year fixed index annuity, and you have these sorts of cap rates, a 10% or a 0%, and let's say the market gains 10% the first year, then loses 20% the second year, then loses 10% the third year, loses 5% the fourth year, then gains 8% the fifth year. What exactly happens with your money? Well, on the gain of 10%, 10% is still underneath the threshold. So you're going to have a gain of 10%. So your account value would go to $110,000. The next year, when it lost 20%, all of your money in any other variable account would have participated in that full loss. With these types of contracts, you're not participating in any sort of loss. It's just going to be 0%. They let that option expire. It goes by 1 year point to points. So then you're just going to gain 0% that second year. It lost 10% on this side. You're going to gain 0% the third year. It lost 5% on this side. You're going to receive 0% the fourth year. And then when it has an 8% gain, well, then it's going to gain 8% on this side. So then essentially you're going to have a new step up. So what you did was you stepped up whenever the market went up, but you didn't lose anything, and your money was preserved and protected and ratcheted in there, whenever the market went down. So it just gives you that peace of mind to beat that pace of inflation and make sure they're successful. So what brings me to the final type of annuity that I really like dealing with a lot is because I believe that it gives an individual the best leverage out there is something known as a hybrid annuity. A hybrid annuity took the idea of a variable annuity with their income rider, and it kind of blended a bunch of different annuities together. The shell of it is a fixed index annuity. So kind of like how the market steps up or flatlines, just like that example I showed you through the index annuity. So when you go and you roll over, let's say in this example, a 60-year-old male rolled over $100,000. Well, on one side, he's going to have his physical money. It's like his account value, right? This is how they deem his actual physical money. This is what's going to be left to beneficiaries. This is what he's going to have restricted liquidity on within the first couple of years, within the first 10 years of his contract. So this account is going to work just like a fixed index annuity, where anytime it's kind of like a bucket with a lid over it. Anytime that the market gains, you're going to receive a gain into the bucket. It's going to open up the lid, pour the gain inside. Anytime the market goes down, you're going to receive a loss of 0% or a gain of 0%. It's going to flatline. So you're going to have that safe, consistent growth on your actual physical money side. Now, what makes it hybrid is we're also attaching an income rider to this account. One of the things I mentioned to you is people hate that immediate annuity aspect or your annuitization aspect with any sort of annuity. What it means to annuitize a contract is you're surrendering your money. If you had $100,000, you're surrendering that money to the insurance company, and the insurance company is going to pay you some sort of income stream. Could be for a lifetime, could be for 5 years, could be for 10 years, whatever your specific goal is. That's horrible because the company is going to win every time. They want you to annuitize your money as fast as possible. That's why a lot of people, a lot of insurance companies, they really push this immediate annuity aspect. Say, okay, give us your money, we'll start paying you out income immediately. But if something happens to you, you don't leave anything to your beneficiaries. Well, just like anything, there's innovations with these products. People were getting pissed off. People did not like how those annuity contracts work, but they liked the concept of annuities. So this blended hybrid, when it came out, it says, well, I like that index side. I kind of like how my account value, how my physical money is going to grow and not lose anything, and beat that pace of inflation and beat out any of the the low interest rate environment. I like that aspect. And then on top of it, what this income rider does is it gives you an income rider base that is essentially like a calculation account. So this is strictly what that cash flow number is. How I mentioned in the beginning, I said cash flow. Annuities are all about cash flow. So what they say is, let's say this 60-year-old male wants to turn on income at age 65. There's going to be a specific calculation on this side that's going to tell him, okay, at age 65, you gave us $100,000. Because of that 5-year deferral, we're now going to give you $10,000 per year for the rest of your life, or for you and your spouse's life, however that's set up. So what happens is, rather than just say at that point in time at age 65 that you're just surrendering whatever's left in your account value, you're able to still leverage your account value, leverage this bucket, while still get paid that lifetime income stream. So any time that you're receiving gains into your account, your actual physical money is still gaining. Let's say if you go and you take, let's say this $100,000 in 5 years gained to $150,000. And let's say, based upon their calculation account, that somehow this income base is sitting at $200,000. And they determine, okay, at age 65, you can get 5% of whatever this income base is, and that equals $10,000. What this goes and shows you is, if you put in $100,000 at age 60, you have a cash flow number of 10% of that $100,000 guaranteed to you at age 65. If you wait a couple of years, then this cash flow number goes up. Maybe at age 66, it's going to be 11%. Maybe at age 67, it's going to be 14% cash flow. But what that's equivalent to saying is, if I'm pulling out 10% of a bucket of money, then I would outlive that money. In a 10-year example, you would outlive that money in 10 years. With these, the reason why we're leveraging the insurance company and this lifetime income is because it's going to provide you lifetime income. If this individual lives into their 80s, into their 90s, into their hundreds, the insurance company is still on the hook to pay you that $10,000 year by year by year by year by year. If you go past that 10-year mark, well, then that's kind of your break-even point. That's where now you're beating the insurance company. So the way that this account value works is, I keep saying, you have restricted liquidity. You can leave this money to your beneficiaries. If, let's say, you went and you pulled out $10,000 from your account, that you turn on your income at age 65, and this was reduced $10,000. Well, understand, this account is still going to grow whenever the market goes up. But let's just say the market crashed and you gain 0% that year. As you pull out $10,000 on this side of your lifetime income amount, your account value is going to be reduced proportionally, $10,000. So now you're going to have $140,000 sitting in your account value side. At that point in time, this $140,000, and let's say, God forbid, you passed away after 1 year, you come down with some sort of ailment, $140,000 is now going to be able to get paid to your beneficiaries. So you were able to leverage the insurance company for, unfortunately, a short amount of time, and still provide your beneficiaries with peace of mind that they did not lose out, that you did not lose out on that account value, all that money that you grew throughout the length of time. If you keep living, and let's say you're taking out $10,000 and this is getting decreased $10,000 every year, let's say you live to 20 years. Well, in this example, if you took out $10,000 and you lived for 20 years, well, then that would have been $200,000. Well, you only have $150,000 in your account value. That's where the company is still giving you, they're still on the hook to pay you $10,000 for those extra 5 years, or however long you live. If you live for another 40 years, understand that's going to be $400,000. You gave $100,000 at age 60 and you took out $400,000, worth of value, worth of cash flow. So that's the way to look at it, is how exactly can you leverage your dollars the smallest way possible to get the max amount of cash flow. So if you have that first example that we went over with the guy that said, he's $500,000, and I'll pull up a new screen. If somebody had $500,000 and they were looking to place money into an annuity, and it was some sort of deferral or some sort of income or some sort of immediate need, well, The most important thing is to figure out what is that need? What is that individual's goals? What exactly is that specific income goal, that cash flow goal that they're trying to accomplish? This person's age 60 and they want to turn on income at age 65. And let's say they receive pension income. Let's say they receive Social Security income. And let's say that their income gap with the remaining assets, with their remaining expenses in retirement, let's say that income gap is $20,000. Out of this $500,000, it's not going to take the full 500. Maybe that will only be $235,000, or let's say $250,000. So that means you leverage $250,000. You have that peace of mind that exactly in 5 years, they're going to be producing you $20,000 per year for the rest of your life. You still have control off of that money because it's still growing, flatlining, growing, flatlining. Whatever you don't use goes to your beneficiaries. And if you keep living, then that company is still paying you like your own personal pension plan. As that's happening, you only use $250,000 into that annuity. You now have the other $250,000 to throw into the market, to have fun with, to play that big casino known as the stock market. But you don't have to leverage all your chips into an annuity contract. And one of the things that we do is we're an independent agency, so we work on a national basis, and we are A+ rated on the Better Business Bureau. But what happens when someone's interested in an annuity, we say, give our 1-800 number a call. It's 1-800-566-1002. We always have a specialist standing by. We're available 24 hours a day, 7 days a week. If you're interested in an annuity or finding out more of which annuity would be, specific to your exact situation, or even if an annuity might work out for your specific situation, we're going to ask you a slew of questions. We're going to try to get your brain thinking, saying, okay, what exactly is my income goal? How exactly can I leverage my money for retirement? Is it just a safe, consistent goal that you're not even looking to turn on income, because you could accomplish that goal through fixed annuities or index annuities? If you're looking for the income, you could utilize the hybrid annuities. You could utilize a combination of different immediate annuities or deferred income annuities, at the same time. So there's so many different ways to skin that cat. On average, with every individual we talk with, we go through over 1,200 different products, strategies, and scenarios before we give our top 3 recommendations to make sure that you are comfortable. It's not just saying, oh, company ABC is the best company regardless of what you're telling us. We're an independent agency, so we represent every single carrier, every single contract in your specific area, so that we could always make sure that we're giving you the best possible advice. And the name of this system, the name of our process is known as the Retire Sharp Planning System. And the name of our website is Retire Sharp. The name of our YouTube channel is Retire Sharp. The name of our website is retiresharp.com. The name of our YouTube channel is Retire Sharp. You can always, subscribe there to make sure you get the most updated videos. But, once again, all it is just a big game of leverage and a big game of cash flow. How exactly can you use the smallest chips possible to make sure you're having the most optimal result? And, I want to thank you very much for watching this video. Please be on the lookout for some of our other videos, and hopefully we'll talk to you shortly.